Hello and welcome. My name's Ray. We've had a pretty interesting past week, so got a lot to talk about. Let's get into it. So we've got the past week, the Australian market has dropped at least 10% down from the recent highs into correction territory. So what does that mean? If we have a look at this recent news story, um, just paused on a screen just mentioning $141 billion at least has been taken from the markets. Uh, so this seems like this has been posted on um, Wednesday or Thursday. So right now, being the weekend, the market has actually dropped further than then. If we have a look at a couple of things, when was the last time that this happened? It would actually be in late 2018, and if I could find it, it would be this drop here around about from end of August to end of December of 13.5%, taking around about 3 months for that to happen. And it has taken like 5 days, 7 days to reach this correction territory. So, why are the markets doing this? It's in relation to the coronavirus. Uh, if we have a look at the recent update or this table here, we've got China currently sitting around about 80,000. But the recent fears have been mainly due to these countries, South Korea, Italy, Iran, and Japan, having their infection count increase pretty dramatically. So right now, China's currently put in a pretty widespread lockdown, and right now trade is reduced, their production is reduced, people aren't being able to go to work, they're locked in their houses. Um, there's tourists and visitors, uni students, also in China, which is currently under lockdown. There's no flights going from China to Australia right now. Um, and just recently, Iran has also been added to that. No, I don't believe Iran has. No, Iran. I don't have that information right now. Ha. Um, but yeah, should these other countries also impose a travel ban and reach the point that China does, the there's going to be a lot more economic impact than we currently already have. The trading partners of South Korea, Italy, Iran, and Japan um, will start off with Italy, uh, really close to Germany. If Italy shuts down, there's a trade partner almost like basically gone from their output slash input, um, and it's it has the potential to cause uh, widespread uh, economic downturns. There's also the big ship, which has a lot of multinationals on there as well, or numerous different nationalities on board this big boat. Um, and the amount of countries is also increasing as well. So this is just like the top 10, top 15. But if we have a look down, that's a lot of people. That's a lot of countries. Um, and each one has the potential to be like China, to be like Korea, if it's not handled well. So, market's scared, people are scared, countries are shutting down, and with China being offline for a little bit, um, so China being Australia's biggest trade partner, causes some concern for our own economy. Uh, does that put us at risk? What currently is China not producing right now sorry, because of people not going to work and things like that. Um, Not sure, um, but right now the RBA slash the government has a little bit of things to think about. Right now, for the RBA, generally what they do to stimulate the economy would be to cut rates, uh, or cut the cash rate. Right now, it's currently sitting at 0.75, which is an all-time low uh, compared to the past, and going from 0.75 to 0 does not have that much of an impact than what has been done previously to handle other recessions. If we have a look at, yeah, I believe it's this one, um, previous Australian cash rate, we've got 08, 09 here, the GFC, where cash rate was cut from around about 7% to around about 3-ish percent here uh, during the downturn. So that's 4%. We can't do that now without going into negative. And negative interest rates is a whole different story. But yeah, right now there's not much wiggle room for them with the interest rate lever to control spending, but they don't have that much in general. What are other things that they could do? They could buy financial assets. They could buy. They could print money. Um, but printing money also has its own issues as well. It's very, very dangerous, um, if not done well. But I guess the summary would be that they don't have that much that they can do. So it would be up to the government to be able to help Scott Morrison and whatever Mr. Frydenberg. Would they actually be able to help stimulate the economy a little bit more than they have done or have not done so far? Not sure, but if they want to keep their surplus, they can, but everybody else would be at risk at losing their jobs. But yeah, right now, with the cash rate, um, it does sort of indicate what you should should do with your money. Um, right now, it's actually a pretty easy decision uh, that having your money in a savings account does not do much. Does not do much. 0.75%. Some bank accounts, maybe in a high yield interest, high yield savings account, might be yielding like 1.5%, maybe. Um, but it's considerably low. It's not this 7% that we had before. As if we had this 7% before, we wouldn't have people throwing their money into markets, as you can get a better rate of return by throwing your money into a savings account or term deposits and stuff like that. But with this, each individual person has has their own set of circumstances. So right now, we've just had like a 10% loss. If we were, say, an older Australian, um, just about to go through or we went through the financial crisis as a saver, has all the money in the savings account, you might be all right. You might be going through it. Yeah, okay, this is fine. Money is pretty safe. But then your return has just been eaten away, and then you might not actually have enough money to sustain on, since you're not getting the returns that you once did, which might cause you to then throw your money into the markets and then have a 10% fall. So if you had, say, like $500,000 and then you lose 10%, $50,000, you're gonna be in a pretty bad spot. But for other people, myself, I'm currently not too worried, even though we could be in a recession very shortly. We could have a 20% market drop, maybe in like the next 2 weeks or something like that. Currently not worried. Um, if we have a look at this chart here, we've got the previous bull markets and bear markets. So I believe this one's for the US, but the idea still stays the same. But yeah, a bear market is defined as the index closing at least 20% down from its previous high close. We're already at 10% in 6-7 days. And these bear markets, on average, looking at these numbers, 16, 25, 3 months, 21 months. These are pretty large, and we're almost going to break that very quickly. But this could also be pretty prolonged as well, selling on top of selling. But if we're just about to hit a bear market, then the closer we are to the start of a bull market, where the start of the bull market is where you get ahead. That's where you get ahead. That's where everything's on discounts. If it's like 2008, 2009, where it coincides with a recession, then people are going to lose jobs. People lose jobs. They can't pay the extremely high mortgages that are currently going on in Sydney and Melbourne. Then defaults happen, and it's all about time. Imagine the discounts that would happen on properties, um, the discounts on companies. It's if you have spare money going into this, and if you have a look where you are in the market cycle, then you can throw yourself way ahead. So right now, this is currently why I'm not scared. I'm not worried. My plan is different to those of, say, retirees. I'm not thinking of buying a house really soon. Not not buying a house really soon, and I'm just buying up these assets. Buying up these assets. A house is an asset as well, but it does require a decent down payment as well. But right now, we're only 10% there. We've got a couple of weeks or months to go. Yeah, I guess I'll put that on pause. If we have a look at what's happening to myself, um, right now I've currently dropped to $95,000, down from 103, and that's after a 10% decline. Um, Shares currently at 62, that's down 6,000. Super's down 1,000, and I've paid off a $1,000 bill, which was the share, no, not the share, the tax return from last year. So paid tax return, paid $1,000, but that has paid off a lot more than $1,000 is, because I also had to pay off a portion of my HEX. I do not consider HEX as a debt. I think of it as an expense, even though it is debt, but I'm not tracking HEX as the as I consider HEX a different type of debt. But with HEX paid off around about 2,600 for $1,000, which is a lot better now than paying for it, paying for it upfront and just working for it, working for it. But yeah, debt's starting to blow out. If we have a look at the closer view, the overall data, since last month, dropped $4,000. But this was at 103, so that's $8,000, was up $4,000. And most of it from shares and super. I have bought another small package of shares. But aside from that, not much has happened. And with the shares, just allows me to buy more shares a lot cheaply, a lot more cheaper. $1,000 added. But the main idea for shares is for income. Haven't had another dividend pop up, so 2,400 for the year with 4 months to go, doing well. And yeah, basically shares is all about income. If the market goes down 10%, 20%, I still hold these individual shares, which are paying this income. It would only matter if they do not continue to pay out. Um, but if I'm still purchasing more and the economy and the market recovers, then I'm coming out with more shares, basically. More shares, more shares, more shares, more dividends, and get closer to this goal of $1,000 per week on average. So this is why I'm not scared, I'm not worried. I still have 39 years. I still have 39 years before I hit the age of 65. That means I'm currently 26. I still have a lot more time to be able to recover from a bear market than those who are about to retire. I have a lot more time to be able to work to earn back this $4,000 only. That might be a month, it might be 2 months. Last time that we were at 95 was in December. So there's not much concern going on at all. If we hit a bear market, sure, why not? If we hit a recession, why not? The only concern about a recession is losing your job, but being defensive, having like a defensive job where my position is not at risk, then why not? I'll buy these houses at cheap. I'll buy these shares at cheap. The only difference to those strategies would be super. Um, super does have a different strategy though. If we have a look at the graph, I did mention it has been rebalanced. And at the moment, having a look at this, the super account is down $80, which is a month. It's down a month. If I spend another month on this, then super will be back at positive, assuming the market doesn't drop further. But I'm still adding to the account. I'm still working. So there's not much concerns. Stay invested. We've got plenty of time to go. Aside from that, I don't have much more to add. Seeing a dip. We've already seen a dip before. But I guess I'll recap what we've gone through already. So we've got coronavirus, which is spreading outside of China, South Korea, Italy, Iran, and Japan. China's currently already shut down. The markets are reacting pretty badly and pulling out of the market pretty quickly. Markets around the world are basically in correction territory, halfway to bear markets. China being shut actually affects the economy, so that puts Australia at risk. And there is risk of a recession. We'll see if we get closer once the January to March quarter is up. If it's negative, then we'll see what the next quarter is in April to June, and we could be in recession in July, assuming this goes all horribly bad, and yeah, that's basically it. So I'll leave it there. Thanks for tuning in. I can't even remember what I talked about, but that'll be it. So I'll see you in the next one. We'll see how the market goes next week. Thanks.